What is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to be checking out Intuitive Surgical stock. I've never bought into the stock, but I've watched it now for several years, and I think the reason I've never bought it is because the valuation always looks high. And if you look at the P ratio history here, you can see that right now we are historically trading much higher than average. But still, even in these last couple of years, when I would look at it trading at 70 times earnings, 80 times earnings, it just seems like really expensive. And so it's kind of hard to predict what a stock like that is going to do. But either way, right now it looks like when it gets to 85, 90, so that's what's most likely to happen for 2025. But we will see. Now, let's see, is this company actually justifying a 80 times earnings right now? So Intuitive Surgical is the largest player in the global robotic surgical systems market with an estimated 57% market share, which is insane. They account for an estimated 53% of total industry revenue. And it says that the robots are expensive. So hospitals that have invested in their Da Vinci machine are unlikely to switch to a competitor, which is a very good point. Surgeons around the world train on the Da Vinci, so they are likely to continue using it. And then the larger the installed base of Da Vinci machines, the wider the moat is around their business. Which these are all great points because this is not like a lot of other businesses where you can easily just swap in for a different competitor and the products are pretty much the same. This is a very hard business. I believe I looked up how much it costs to make them. I believe it's about $2 million or so to make these machines. So this is not an easy business to replicate. And they are in a great industry, a innovative, growing industry, and they have an insane amount of market share. So right off the bat, that makes me think that, they deserve to have a way higher valuation or higher premium. Now, that could mean 40 times or 50 times earnings, but 80 to 90 times earnings is on another level. That's sort of getting out of hand, but it is what it is. If the stock wants to keep trading at these ratios, then that's what we're gonna have to pay for it. So they're not growing any insane amounts. It's not like they're growing 40% per year. They're growing 14% this year, and the next year it's expected to be close to 17. So healthy growth rates, but nothing insane. Let's see, how old is this company? Founded in 1995. Okay. So $192 billion market cap. Last couple of years of revenue is looking strong. Growth is very consistent. They're doing 7.8 billion in revenue. And then we have net income, which is fluctuating a little bit more, but still very healthy. Trailing 12 months of $2.2 billion of net income. And that is honestly insane that they're doing that much just off of 7.8 billion in revenue. And as you can see here, the profit margins are very healthy, 27% for this past quarter. And so I like what I'm seeing here. The cash balance is coming down a little bit, but they have no debt, so that is phenomenal. Over $4 billion of cash. Otherwise, everything else looks good to me. If we run the numbers for their future EPS, we're looking at this year, we're paying 79 times. And then next year, we are paying 69 times. So if you think about that, let's say we're right around this number, right? So if you're paying for 2025, then this is a fair valuation for next year's earnings. But what that kind of means is that the stock could hang around this stock price until the end of next year, which we don't want that. We want to get it cheaper. So we really want to get it at like 60 or 65 times earnings for next year. Or if a couple months goes by, and let's say we're in next spring and the stock is still at this price, then I'd be happy to buy it because I would like to own this stock. It's just it has to be at a fair valuation. And if the P ratio is this high, it just doesn't make sense for me to buy right now. But if we did get a 20% dip or something, hopefully in this, then I'd be happy to buy. So here is the history of the P ratio 86. It's at pretty much all-time highs right now. This is just not a good time to buy. Forward PE of 69, again, definitely on the higher end of the spectrum here. It's traded, just a year ago, it was down to 45 and 52 times earnings. Now we're on the higher end of things, 69 times. So I do not want to pay that. And that's it. I really like the business. I like the business. I like the margins, the model, everything about it. The financials look good. Just the valuation is kind of high, and that's normally what happens with great businesses. You got to pay high valuations, but it doesn't mean we need to pay 90 times earnings. It means we could also wait for it to come back down to 70 times earnings or so. Then it'd be something to consider buying. So that is my analysis for Intuitive Surgical. Let me know what you guys think down below.